make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on. Call in now. 855-4-SHIP. That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Welcome, everybody. This is Peter Schiff, broadcasting live from the Radio America studios here in Virginia, en route to Washington, D.C. tomorrow, where I will be testifying before the House on how to create jobs, or more importantly, how to stop destroying jobs, and why Obama's jobs bill will be a job destruction bill. And actually, I'm probably going to put out online the written testimony that I'm going to be submitting into the record tomorrow. You know, they actually are requiring me to give them 30 copies of my written testimony. Now, I'm actually not going to read what I write because they're only giving me about 5 minutes to talk. And so I prepared some written information that exceeds that. Plus, I'm also going to be giving every member of the committee a copy of the original crash proof and a copy of How an Economy Grows and Why It Doesn't, just so they could read that. But I'm submitting this testimony, which I think we'll put online and make it available so you can see exactly what I am giving the members of the committee. But basically, I get 5 minutes to summarize that written testimony. And then most of what I tell the congressman is going to be in the form of questions and answers. So I think the whole thing is about 2 hours. I'm not sure how many other people are on my panel. I think it might be 2 other people that are there with me. So I'm not going to have the stage to myself, but hopefully I do get enough questions, especially concerning my own experiences as a businessman, not just my understanding of economics, which I hope to impart to them, but also just the frustrations that I've experienced firsthand as a result of government regulations and the way it diminishes my ability to grow and to hire people, and how this new bill that they have passed is not going to cause me to hire anybody that I wasn't going to hire in the first place. It's not going to influence my hiring, other than, as I said, it is possible that I might be able to temporarily hire some minimum wage people because obviously the effect of this bill is to dramatically reduce the minimum wage, at least for a short period of time. So we might be able to hire some students or things like that temporarily, which is obviously good for those students. But it's more of a better way to do it would be just to lower the minimum wage. But this is a roundabout way of doing that. And so some of the jobs that the minimum wage is preventing from coming into existence will come into existence. But the problem is the damage to the economy of the additional deficits that will result from this bill will more than offset the benefits of creating some more minimum wage type jobs. But anyway, let me turn my attention to the markets. The markets are rallying as we speak, even though the Dow is still down about 11 points. This is the high of the day. You know, the S&P 500 futures are down about 3.5 points, but an hour and a half before the open, futures were down 24 points. I don't know what the exact Dow equivalent was, maybe about 200 points of downside pressure on the Dow about an hour and a half before the opening of the market. And so we've been rallying all morning to get to the level where we are right now. Also, the U.S. dollar that was higher, or more, it's more of a euro. The euro, which was down quite a bit overnight and earlier this morning, the euro is now basically unchanged. It has recouped a lot of what had been lost overnight and earlier this morning. The catalyst for the decline in the euro and the decline in global stock markets is the renewed fears that really surfaced on Friday regarding the potential for Greek default. The rumors were spreading around that Greece would default, and then there are now rumors that Germany is bracing for a Greece default. All the while, Greece is assuring the world that they're not going to default. Now, that doesn't mean that they won't. Obviously, generally, politicians will say one thing right up until the point that they do the opposite. I think, of course, a Greek default would actually be good for Greece and good for the Eurozone. And I don't think that a default means that Greece has to leave the Eurozone. I think they can stay in the Eurozone and default because they can still use the currency. Look, we've got companies, we've had municipalities that defaulted in the past. Not many, but I mean, they don't leave. They don't have to secede. I mean, what if California were to default on its bonds? Does that mean it has to secede from the Union? That it can't be part of America anymore just because it defaulted and because it uses the dollar? As I said, I think it's healthy for the Eurozone if lenders know that sovereigns might default because they won't lend as much money. Because remember, if the Eurozone is going to guarantee, somehow put in place a guarantee that no member country can default, well, that's a huge moral hazard because now the interest rates in Germany would be identical to the interest rates in Greece because the euro would stand behind all sovereign debt. They can't do that. But, of course, Greece is still trying to maintain that it won't default. It announced today some tougher measures in order to qualify for additional loan payments in the bailout plan that was announced some time ago. What Greece said they were going to do is reduce the pay of Greek government employees and also impose a national property tax. So it's a combination of additional revenues and spending cuts to try to qualify for the next round of bailout payments. And so maybe that is what is soothing the market. Maybe some people are starting to think maybe Greece won't default, or maybe people are starting to realize that a default won't be so bad, that restructurings are better. And in fact, one of the reasons that people keep saying that Greece should leave the Eurozone is so they can go back to the drachma and devalue. Well, if the Greeks simply converted all their debt to drachma, if they said, okay, if you own a Greek bond, we're not going to give you euros anymore, we're going to give you drachma, and the drachma were to lose half its value against the euro, practically speaking, that's the same thing as a default or a restructuring where you pay 50 cents on the dollar. So it doesn't mean that Greece avoids default by leaving the euro. There's still default. The thing is that if it does it through a restructuring, it's much healthier, it's much better than going back to the drachma and wiping out their debts that way. That's a worse way to default. But, of course, I think it's better for the Greek people to have a restructuring where they don't pay back all this money that's been borrowed. Because the problem with the Greek economy, just like with the American economy, is too much debt. And the solution isn't to find ways to make the debt bigger. The solution is to work out of it, is to remove a lot of the debt overhang from the economy and to remove the moral hazard that makes it so easy for people to borrow because lenders are so cavalier in their willingness to lend because they think that some government entity has got their back. We need risk to be allowed to work its magic in the market. Because remember, it's not just about greed, it's about fear. It's not just about rewards, it's about risk. You don't have a free market if you don't have the counterbalancing forces of risk and reward. It's when government comes in with regulations and subsidies designed to limit risk that capitalism doesn't work. And of course, when it doesn't work, it's not capitalism that gets the blame. I mean, it's not government that gets the blame. It is capitalism itself. Anyway, we'll be back. We got a lot more to discuss here on the Peter Schiff Show on SchiffRadio.com.
The Peter Schiff Show. Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million. Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
And we are back. Anyway, looking at some of the other markets, the metal markets are down, both gold and silver. Gold down about $23 on the ETF GLD, silver about 50 cents. The interesting thing, though, is overnight, gold made a new record high in terms of the euro. Now, this has pretty much been the pattern, I think, for the last year or two, that each time gold has made a new high, it's done it against the euro before it does it against the dollar. And then what's happened is gold has gone on and made a new high against the dollar as well. And I think every time, at least so far during this bull market, every time gold has made a new high priced in euros, it's gone to make a new high priced in dollars. So my forecast would be that a new high for gold in terms of dollars is in the cards. Now, I know they always try to tell us in the securities industry that past performance is no guarantee of future success. But, you know, if someone tosses a coin heads 10 times in a row and they ask me, what do you think they're going to toss next? I'm gonna pick heads, you know. And I know that, you know, there's no past performance, there's no guarantee, but hey, something's going on there. Otherwise, it wouldn't come up heads so often. So, if I were a betting man, that's what I think would happen, is that there's some reason behind this, and that gold is probably going to make a new high in terms of the dollar as well. It's only a question of time. And typically, if you go back at this bull market, it hasn't taken a lot of time. It's been a pretty short window between the new high in euros and then the new high in dollars. Gold stocks also down today, but again, continuing the outperformance. The Huey index is down, but it's down less than 1% today, whereas gold is down 1.25%. So again, gold stocks showing a relative performance even in the down market, which again shows me that there is more strength in the markets, and that, you know, rather than a bubble having burst, that a new leg of this bull market is now underway. Hey, I also want to talk about something in the news, very interesting story that really kind of confirms what I've been saying. And this is a story about the U.S. Beginning to export more refined oil products, gasoline, diesel. And the article is pointing out that even though domestic demand is down because of the recession, that supplies are also down. And it points out, I think, that diesel supplies were off significantly. And so what's happening is the refineries are exporting gasoline and diesel to the rest of the world. And so even though domestic demand is falling, domestic supply is falling, and so prices aren't coming down. And the article even points out one of the reasons for the trade deficit coming down last month was that we imported less oil. And so this is what I've been saying. Remember, people always say that, well, if we have a slower economy, prices have to come down because there's less demand. Well, not necessarily. What if supply declines faster or more than demand? Then prices would rise even if there's less demand. And that's what happens, because as the U.S. economy slows and as the U.S. dollar loses value, it makes more sense for American companies to export their products rather than sell them here in America, because foreigners can afford to pay more. So more of what used to be available for Americans is now sold abroad. In addition, as the dollar goes down, we can afford to import fewer products. So maybe products that the Chinese, for example, might have been selling to America, all of a sudden they decide, wait a minute, we can get more money selling them to Chinese because the Chinese RMB has risen. So fewer products end up getting shipped from China to America because more Chinese are buying those products. So what happens is the weakening economy and the weaker dollar means that there are fewer goods available for sale in the United States. So what it means is, yes, there's less demand. Not as many Americans are buying things, but those Americans who are buying things are having to pay a lot more for the privilege. And that is exactly what happens in a contraction. See, people who think that, well, a weak economy automatically means less inflation, no, because they're simply focusing on demand and they're not focusing on supply. Because a weak U.S. economy will reduce the supply of goods available for Americans to consume, and that puts upward pressure on the price. But one of the things that's interesting, and if you look at this article, and it's up on my Europac website, if you can't find it just by doing a search, go to europac.net and look for the article, U.S. exporting more gasoline and diesel fuel. Look at the comments, because the comments really tell a lot about the American socialist attitude, where if you read the article, your comments, people are mad at the oil companies. They're saying this is an outrage. They're exporting our oil to foreigners. Our oil. Like the oil is owned in common by the public. It's not our oil. The oil belongs to the owners, to the people who own the wells, who own the rights, the corporations that are pulling. It's private property. And if you own something, you can do with it whatever you want. You don't have to sell it to an American. You can sell it anywhere. I mean, do people get upset because Apple is selling iPods to other countries? I mean, why are somebody say, hey, those are our iPods? Why are we exporting them to Europe? I mean, why don't we force Apple to just sell them here? That way the price would be lower. You could see the drumbeat maybe down the line as this starts to happening. What if they say, hey, U.S. oil companies, you can't sell oil abroad, or hey, you're a refinery, you can't sell your refined oil to the highest bidder. You have to sell it to Americans. I could see the drumbeat for that type of socialist nationalization of our resources. Hey, they belong to Americans. But you know what? It would backfire if Congress passed those laws forbidding those exports, which I don't even think, again, would be constitutional because they can't tax exports. But I don't know if they try to use the Commerce Clause, and I'm going to talk about the Commerce Clause later on too, for another factor that's in the news. But if they somehow use the Commerce Clause and somehow figured out a way to prevent U.S. businesses from exporting, it wouldn't bring down the cost. It would actually backfire. Because as a result of diminishing our capacity to export, the dollar would be even weaker, the trade deficit would be even higher, imported oil would get even more expensive, U.S. businesses would be less competitive, and they would be raising their prices even faster. So it would backfire. But I could see the drumbeat for that mentality. And again, read some of these comments and see some of these attitudes that Americans have for private property. And the right to price your products the way you want to price them, the right to sell your products to whomever you want to sell them to. Just because a product is manufactured or produced in America doesn't mean that the country can lay claim to ownership of those products. The products are owned by the individuals or a collection of individuals, the corporations that produced them, that took the risks. Because obviously, what if they'd have made a loss? I mean, the loss isn't so nationalized, so neither should the profits. Anyway, let me go to the phones. On hold is Tom calling from Laughlin, Nevada. Tom, welcome to the show.
Thank you, Peter. I'd like to make two quick statements to see if you agree and then ask you two questions.
All right.
Even if the money supply remained constant, general price levels can vary.
Okay.
Okay, and as an economy gets stronger, price levels decline. You already talked about that earlier.
Absolutely. So those are your statements. What we got to do, though, is we're coming up to a break, so hold on, and we'll get to your questions when the show resumes after this brief pause. So stick around. You've got a lot more of the Peter Schiff Show coming here at SchiffRadio.com.
Falando das coisas belas e das coisas simples.
The Peter Schiff Show.
Mostrando como belo pode ser simples e simples pode ser belo. Ai, 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 ai. Ele chegou descontraído.
We now return to the Peter Schiff Show. Call in now, 855-4-SHIFT. That's 855-472-4433. Real Radio, the Peter Schiff Show.
You are listening to Peter Schiff here at SchiffRadio.com, and on the phone with me now is Tom in Laughlin, Nevada. Before the break, Tom had a couple of comments which I agreed with regarding inflation, prices, economic growth, but apparently you have a couple of questions. So fire away.
Okay, thanks, Peter. Given those two statements, why do they equate rising prices with an overheating economy?
Well, the government tries to blame rising prices on economic growth. They don't want to accept responsibility. So the whole idea is to try to blame the fact that prices are going up on the economy. Push it on somebody else. And so the idea is that, well, prices are going up because there's more demand and people want to buy things. And so because there's more demand, prices are going up. But they ignore the fact that legitimate economic growth would mean there's more supply. that a growing economy produces more stuff. And so that should push downward pressure on prices as there are more things to buy. But what happens is when the government creates phony economic growth, when they simply print money and then the numbers go up and you see the GDP is going up and prices are going up, the government will say, oh, prices are going up because the economy is growing. But no, the economy isn't really growing. It's just that the phony growth is going up, and so prices are rising to reflect that. So the same actions that the government takes to produce phony economic growth causes prices to rise. So the two do happen simultaneously, and so some people make the false logical jump that, well, the GDP is going up and prices are going up, therefore the strong GDP must cause rising prices. No, the reason that the GDP is going up is the same reason that prices are going up, because the government is printing money. But that GDP number going up doesn't really mean that that the economy is improving, because, you know, now they're supposed to adjust the GDP for inflation, but the numbers don't work. And so a lot of it, too, has to do with the phony belief in the Phillips curve that, well, you know, if you have a growing economy, you don't have a lot of unemployment. And if you don't have a lot of unemployment, that puts upward pressure on prices because the people that have jobs are buying things. Yeah, but they're also making things. You know, people who are working they're making stuff. So that should put downward prices. So the whole thing is backwards and wrong. But it's the government is attempting to deflect the blame of inflation away from itself towards other things.
Exactly. It indicates a fundamental misunderstanding of economics. And given all that, then what the heck does overheating mean? The word in that context.
It doesn't mean. I mean, it's all trying to give the government the ability to fine tune. They try to describe the economy like it's an automobile. And, you know, you step on the gas to make it go faster. You step on the brake to slow it down. If it's overheating, you cool it off. I mean, this is all nonsense. It's like the government cannot drive the economy like it's a car. You know, right. and you know, real economic growth, it doesn't matter how fast it is, it doesn't produce inflation. If it's real, there is no speed limit on the economy. The economy can grow as fast as it wants. The government doesn't have to cool it off, you know, if it's overheating. So this is all this Keynesian nonsense words, and all it's really doing is justifying government micromanaging the economy, you know, tinkering with it, fine-tuning it. It doesn't work. What we need for the government to do is stay out of the economy. Just provide an environment where the economy can flourish. Enforce the laws, provide sound money, and, you know, enforce contracts. Stay out of the way. Let the free market operate. When governments succeed in doing that, economies expand dramatically. And the more the government interferes and tries to micromanage, the less growth you have, and the more inflation you have.
I agree with that. And in other words, overheating is just a form of doublespeak. I mean, when they use it like that, it's deceptive. And then you can tell Eric one thing next time you see him. Tell him that eliminating corporate taxes to repatriate profits, and then telling corporations that they have to pay 25% of it to create jobs, won't work as good as just letting them repatriate the money without any strings attached.
Yeah, you never want strings attached, because then the government is replacing its judgment for the market's judgment, its judgment for companies. And obviously it's not going to be as efficient an allocation if you allow market forces to determine where resources go and not government decree. But, you know, we're going to have a debate like this, so stick around. At the top of the next hour, I have an economics professor who's coming on to argue that the government spending can create wealth and create jobs, and I guess he's going to be a proponent of the Obama plan. And so it'll be an interesting discussion, because we'll be able to hear firsthand this perspective on how government spending somehow is going to improve our economy. Anyway, next on hold is Richard calling from Indianapolis, Indiana. Richard, welcome to the show.
Hey, thank you, Peter, for taking my call. I just had one question this morning. It was related to sovereign debt issues. This morning they've obviously started talking about some major concerns about Greece ultimately, you know, finally officially defaulting on its sovereign debt obligations. And I know in the past you talked about kind of a cascade effect where investors would kind of start to wake up to the major issues, not just, in Europe and the United States, but just worldwide as to the issues with sovereign debt. For example, they would, first it would start with like a small country like Greece, then they would look at the bigger countries in Europe like Italy or Spain, and then ultimately they would turn to the major issues we have in the United States. Do you think maybe this is the start of that trend, or
well, I don't know. I mean, I don't know that Greece is about to default. I mean, as I say, I think it's good for the Greek people. I think it's good for the Eurozone if we have legitimate defaults. And then the losses are borne by the lenders, not the entire population. And you have moral hazards, and you have some brakes on the ability of governments to borrow, which would be great for the countries that have been plagued by excessive government borrowing. And I think, though, either way, either they're going to solve the problem of European debt for a while. So maybe solve is not the right word, postpone, and maybe, put a Band-Aid on it long enough to deflect the concern back to America. Or we're going to have a round of defaults in Europe. And then, of course, the next thing will be the U.S., because once all the European defaults are out of the way, who's next? And I likened it to, subprime and prime. Everybody used to say that, the subprime, we don't have to worry about the mortgage market. It's just in subprime. It's contained to subprime. It's not going to spill over into the prime. And I said at the time that was nonsense, that the prime mortgages had the same problems as the subprime. It's just that the subprime were the weaker links in the chain, but ultimately the whole chain was going to go. And that's what you're having. I mean, we've got as big a problem, if not bigger problems, than Greece and Ireland. It's just that Greece and Ireland aren't issuing the reserve currency. They can't print. We can, and so they're the tip of the iceberg. But I mean, we're the real iceberg, and so one way or another, the market's going to work its way up the food chain, and it's going to get on us. And I think if we start to see some defaults, and the euro were to weaken as a result, I think that's going to indicate a low point for the euro. I think it'll most likely rally if you get some kind of a sell-off in the currency based on defaults. But obviously, too, if they can postpone defaults for a period of time, I think that's also a positive for the euro, because one of the reasons that the euro is so weak is people are afraid of default. But I think when default actually happens, I think a lot of the people who have been shorting the euro will look to buy it back. And then I think we'll start to focus on the U.S.
Right.
Yeah, and as I said, I think we've got issues. I mean, right now, interest rates are still really, really low, which is helping out all the debtors, but it's simultaneously hurting American creditors who are being paid next to nothing. But at some point, we're going to start to see problems, not only for the federal government, but for our own states and municipalities, where we're going to see defaults here. And that's also going to be very problematic for the dollar. Because, what's going to happen if a major state were to default? What about all the investors? What about all the funds that own those bonds? And what's going to happen? Is there going to be a federal bailout? Is the federal government going to allow a state to fail? And if not, how much inflation is going to have to be created to bail it out? And if a state is bailed out, what about the moral hazard? What about all the other states? These are the problems that are plaguing Europe right now. They're coming to America. Just a question of time.
So, I mean, so basically when you talk about states defaulting, obviously the obvious major, huge concern in the United States being California.
Yeah, but it's not just California, but California is huge. I mean, California is a much bigger part of the U.S. economy than Greece is of the Euro economy.
Right.
I mean, Greece is kind of like Rhode Island.
Yeah.
So, I mean, California is big. California is like Germany. So, I mean, maybe not the same percentage, but I mean, it's the biggest state. So California is the biggest state in the United States, just like Germany is the largest economy in Europe. And right now, Germany is sound. There's no worries about Germany. The problem is that the people are worried that Germany doesn't want to keep bailing everybody else out. Yeah. Now, how many people in different states want to pay taxes to bail out California?
Right.
And they might not want to pay the taxes, but what if the Federal Reserve starts buying muni bonds from California?
Yeah, that would.
And then they're printing money. I mean, and then and everybody is suffering. But then once that happens, I mean, the moral hazard is enormous, because once the state realizes that it can push off the cost of its own debt onto its neighbors, then the moral hazard is for each state to borrow and spend as much as possible. I mean, why not just cut taxes, just randomly? Hey, we're just going to cut our taxes because we're going to make the other states pay for our government spending. So these are difficult issues, and we're going to be right in the middle of this. We're going to have sovereign debt discussions in America, the states, the federal government. I mean, right now we all think that it's okay. We don't have to worry about it because we got a printing press. But that's not a panacea. The fact that we have a printing press makes it worse. Anyway, hey, thanks for your call. Thanks for listening. We'll be back. When we come back, I want to talk about the Interstate Commerce Clause, Congress's move to potentially enforce gun laws from one state to the next. I'm going to talk about my own experience with the Interstate Commerce Clause in the brokerage industry. So stick around. We'll be right back.
The Peter Schiff Show. To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America, we're sorry. We're sorry. Peter Schiff is back on the air.
This is Peter Schiff here at SchiffRadio.com. And I want to change gears a little bit and talk about the Interstate Commerce Clause. In an article that I was reading today, you could find the article online regarding Congress debating whether or not they want to pass a law. Apparently it's in the House right now. It's got some broad backing among Republicans that would require states that themselves have concealed carry laws for firearms to honor a permit from another state. And pretty much almost every state in the union, with a couple of exceptions, does allow, with a proper permit, individuals to carry firearms. But the problem is, what if you live in one state? I live in Connecticut. What if I have a concealed carry permit and I want to take my gun into the state of New York? I can't do that unless I have a license in that state as well. Now, there's some states that have on their own reciprocity agreements with other states, but a lot of them don't. And so Congress is saying, hey, let's pass a law and says, look, if you allow it anyway, so if a state allows concealed carry, we're just going to require that they allow it. Somebody in another state, it's kind of like with a driver's license. Right? If you have a driver's license in Connecticut, I could drive my car in New York. I don't need to get a New York driver's license. I don't have to get a driver's license for every state I drive into. New York will respect my Connecticut driver's license. So they're basically trying to say, hey, we're going to pass a federal law that says, look, if somebody has a license to carry a gun in another state and you allow guns to be carried in your state, you're going to honor that license. And part of the article is written because they're trying to criticize the Republicans and trying to make them out like they're hypocrites, because they're saying, hey, wait a minute, aren't these Republicans, aren't you caring about states' rights, and aren't you always talking about the fact that the government is using the Commerce Clause in an inappropriate way, which of course it is. I mean, it's trying to get Obamacare through based on a bad interpretation of the Commerce Clause. And so isn't this just hypocrisy? Isn't this the same thing? Well, I don't even think so. I actually think here the federal government might actually have the right under the Commerce Clause to do this. And if you think about it, it certainly is worthy of a discussion or of a debate, because theoretically this actually affects commerce in a way that maybe the founders had in mind. Because let's say I'm in Connecticut and I'm a traveling salesman and I want to go into another state. Let's assume that I'm worried. Let's assume there's a lot of crime in that state and I want to protect myself. If I can't take my gun into that state, maybe it affects my ability to go to this. Maybe I don't want to go there. What if I'm just trying to cross? What if I'm trying to do business in New Jersey and I have a right to carry my weapon in New Jersey, but I don't have the permit in New York? How am I going to get to New Jersey without driving through New York? What if I can't take my weapon with me? What if I'm afraid and I don't go? Or what if I'm just a shopper? What if I want to go and frequent a store, but I'm afraid to go there because it's in a bad neighborhood? I want to. So you could certainly make an argument that if a state is not letting me bring my firearm into that state, that they're impeding commerce. So I think it's a much better argument than the one they use to justify the minimum wage or something like that. But the interesting thing would be, if they pass this law, if the courts reject it, that actually might be a good thing, because maybe the language that was used to say that the federal government couldn't force the states to honor handgun laws of other states, maybe that would start to unravel a lot of the other things that the government has been able to get away with by using the Commerce Clause. So I'm not really sure which one I would be pulling for in either way, because I think we actually might win if we can rein in the Commerce Clause. But what it really made me think about, I don't know a lot of people know this, but in the brokerage industry, and this is where I'd like to see the federal government pass a law, and I think it would be very valid. I'm a stockbroker, but in order for me to do business in another state other than where I'm located, I have to register in that state. In fact, each state of the union requires both firms and brokers to pay a fee to have a valid stockbroker license in that state. And it's not a one-time fee. It's a recurring fee. You got to pay it every year. And I can't do business with somebody in another state, even if they're related to me, even if it's my mother, even if it's my brother. If I'm not licensed to do business in that state, I can't accept a client. And the whole thing is ridiculous because every stockbroker passes the same Series 7. The requirements to be a stockbroker in California are identical to the requirements to be a stockbroker in Florida. The tests are the same. It's all the same. Yet why are these fees? And here's how much it costs. If I want to register in all 50 states as a broker, it costs about $3,600 a year. Every year I got to pay that fee. So if a firm's got 100 brokers and it registers them in all 50 states, that's $36,000 or $360,000 a year in fees, in addition to about the $14,000 or $15,000 it pays for the firm to be registered, because both the firm and the broker have to be registered. And all this does is interfere with interstate commerce. It drives up the cost of doing business. It inhibits competition. In fact, it's not only the brokers. Let's assume a broker wants to hire a sales assistant that doesn't even sell the investments, but simply helps the broker run his business. And she's a licensed broker herself. And if the broker wants to compensate her by giving her 2% of his commissions, he can't do that unless the sales assistant is also licensed in every state in which she's getting a percentage of the commission. Because the regulations, it's not only about selling securities in the state, but you have to be licensed in the state to receive any of the compensation of a security generated in that state. And also, it's not even just interstate commerce. I'm in Connecticut. Let's say somebody from New Jersey drives over to Connecticut, comes into my office, sits down in my office and says, I want to open up a brokerage account with you. If I'm not registered in the state of New Jersey, I can't accept that client. Even though they drove to Connecticut, came into my office, we're not using the phones, we're not using the internet. If they have an address that's in a state that I'm not registered, I can't do business with them, even if all the transactions are taking place in the state where I am. And if you think about all the unnecessary costs that this burdens on the brokerage industry, because we don't register all of our representatives in every state. It's too expensive. But now we've got to divvy up the leads. Okay, who's registered in this state? Who's not registered in that state? Who can get this lead? I mean, let's assume I'm a broker and I've got a client that lives in a state I'm registered, and he refers his son to me. And the son calls up, and maybe the son doesn't have a lot of money. He wants to open up a small IRA. If I'm not registered in that state, I can't take that account. I've got to find a friend of mine, another broker who is registered. Now, even if the initial transaction gives me enough commission to offset the cost of being registered, I've got to pay that fee each and every year. So it's an ongoing fee. So unless I'm going to get a lot more business out of this client, it's prohibitive for me to pay the fee. But the whole thing, all it is, you've got every state trying to erect a barrier to trade, protecting its local brokers from competition, but it backfires because every state is doing the same thing. And this would be the perfect opportunity for the federal government to use the Commerce Clause to get rid of these regulations and say, hey, if you're a licensed broker in one state, the license is good all over in every state, and you don't have to pay these fees. That would be a valid use of the Commerce Clause, and I think that would dramatically improve the competitiveness of the brokerage industry and help the consumer, not hurt them. Anyway, we got another hour's coming up, the Peter Schiff Show. We got a great debate coming up on government spending and the best way to create
You make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on. Call in now. 855-4-SHIP. That's 855-472-4433.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show.
Welcome back, everybody. This is Peter Schiff at SchiffRadio.com. Joining me now is Carl Smith. He's an assistant professor of public economics and government at UNC Chapel Hill, where he has been a professor since 2007. Professor Smith, welcome to the show.
Hi, thanks for having me.
Great. Anyway, so what I wanted to really talk about here is the role of government and government spending, and whether or not government spending is a stimulus to the economy or a drag on the economy. Can government really create economic growth simply by spending money? Can government create jobs by spending money, or does government inhibit the creation of jobs by spending money, and does it actually detract from economic growth? What say you?
So, I mean, it depends on where you are in the business cycle is what I would say, but it's certainly possible. I mean, I think that's the issue that we want to get. It's certainly possible government spending could increase economic growth and certainly increase employment in the economy.
Well, I mean, how does it? Let's stick with employment first, because obviously we've got President Obama's speech and his job bill. I am going to testify tomorrow in front of Congress on why the government's job bill will destroy jobs rather than create them. But how do you think? How does government create jobs simply by spending money?
Okay, so I don't think the spending of the money in and of itself is what matters. I think it's the increasing of government debt. But I mean, we can talk about it any way because it all wraps around any way you want to look at it. But essentially, so the government buys things. Those things goes out in the private sector, hires people. Those people then are employed and have jobs. So if you were to say, we need to build a road, you bid out a contract for the road, someone would win the contract, they would then have more they would then need more employees.
Yes, I understand. I understand that process. Obviously, the government buys something, the government does something, but where does it get the money? And what isn't done because the government took that money, right? Because it has to get the money from somewhere to buy stuff.
So essentially what will happen is that the Federal Reserve will simply print the money to do it. Now, now there's a lot of confusion, I think, because of quantitative easing and other programs. But as long as the government holds interest, or the Federal Reserve holds interest rates constant, that's what always happens when the government goes out and buys something. Because the natural response would be for the government to borrow money and for that to bid up interest rates, right? So the government is trying to borrow more money, that pulls on the demand for loanable funds, and so the interest rate rises. In order to stop that, the Federal Reserve has to print money to push the interest rate down. Right?
Okay, yeah, I understand. Because if the government were to go in there and borrow money to spend it, then somebody else who otherwise would have borrowed that money is priced out of the market. There's crowding out. And so you're simply replacing the economic activity that took place absent government interference with some other activity that the government financed. So you're trading one job for another. But what you're saying is we can get around that problem if the Fed just creates some money out of thin air. But do you see any negative consequence to the economy, to job creation, by more money printing?
Well, so at this point, I would say on net, no, right? So there are always winners and losers to the policy, and so people who hold cash are going to be losers. But most of the real economy, I think, will be winners at this point. Now, if you were to keep doing this over and over again, you would eventually bid up inflation, And then inflation would have enormous drags on economic growth by distorting prices in financial markets.
But why doesn't, if the Federal Reserve is going to increase the money supply right now to finance government spending, why doesn't that immediately impact the economy? Because you're creating the inflation, you're expanding the money supply right now. Why isn't there any negative effect immediately associated with the fact that we've now created money out of thin air and the government has used it to buy things?
Okay, so there's a lot there, but the printing money immediately doesn't have an immediate effect on the price level.
Well, sure it does. Well, sure it does. I mean,
no. I mean, okay. So, I mean, you tell me your point, but I mean, this is, I think, the
okay. How about this?
Monetary economics.
I know. I hear somebody crying in the background. So, but
I'm sorry. I'm home with my son. So, I'm sorry.
I don't know. I don't know if he's crying because he disagrees with what you're saying, or
no.
but anyway. But you see, here's what happens. You see, when the government prints money, maybe prices were going to fall. See, let's say we're in a recession, and part of the solution to the recession is a readjustment of prices. Maybe there's a problem in the economy because prices are too high, and costs have to come down. Maybe labor costs have to come down. Certainly when you have a lot of unemployment, that's a sign that wages are too high. They need to come down. Maybe prices have to come down in order to readjust the economy. The Fed comes in there into a weak economy and prints a bunch of money. Prices that would have come down now don't fall. And so by printing money, the Fed is stopping prices from falling, which is preventing the economy from healing itself.
Well, so some prices are stickier than others, right? So one of the prices that you brought up a good point, one of the prices that it's really sticky in the economy is the price of labor. And we debate about why that is, but it's hard to push wages down. And so what will happen is in a bad economy, some prices will fall, but the price of labor won't fall. And that will act like the relative price of labor is going up. And so that makes workers more expensive, and so you tend to shed workers. And so if somehow you could break that cycle, if somehow you could, make wages perfectly flexible, then you wouldn't have this problem. In fact, I mean, if you're a traditional monetary theory like yourself, you would say if all prices and wages were perfectly flexible, there would be no such thing as a recession.
Well, I think an easier way, but yes, and I do agree, and that is one of the quote-unquote benefits of creating inflation is it lowers wages, and it's lower wages that create employment, not the inflation itself. But a much better way would be to abolish the minimum wage. How about just instead of reducing the minimum wage to inflation, how about get rid of it and also stop subsidizing people to not work? One of the reasons that people don't want to take low-paying jobs is because they can get unemployment benefits for a long period of time. If you take that away from them and force them to work, and then you eliminate a lot of the laws that are preventing lower-paying jobs from coming into existence, you'd get that's a much better way to increase employment than just to create inflation and decimate people who are living on a fixed income. And also, when you create inflation, you are making the cost of business going up. Oil prices go up, other raw material prices, components. You're making doing business more expensive. And so if the recession is bad, driving up the cost of business is going to make it worse.
Yeah, but if inflation happens in all prices, then it doesn't change the relative price of doing business, right?
No.
So it's only the stickiness of some prices that would do that. Like if the price of labor doubled, the price of your output doubled, the price of your supplies doubled, it's really just the same. Everything's just got.
Well, it's not all the same. We're going to pick this up. We got a commercial. Maybe you can tend to the little one, and we'll be back in just a few minutes. Stick around. We got more of this discussion coming up here on the Peter Schiff Show.
The Peter Schiff Show. Since the Peter Schiff Show was last on the air, the national debt added another $7.89 million. Luckily, Peter's intelligence is growing twice as fast.
That's incredible.
Welcome back to your source of sanity in an insane world. It's the Peter Schiff Show.
You are listening to the Peter Schiff Show. On the phone with me now is Carl Smith, Assistant Professor of Public Policy at UNC Chapel Hill, and we're talking about government's effects on the economy. And, you know, Carl, you know, if I'm a business and I'm having problems selling my products, you know, one of the reasons might be that the prices are too high. People can't afford my products, and maybe falling prices would help me sell the products. And so if the government comes in and creates inflation and prevents a lot of my input costs from going down, you know, and yet drives up other prices. Like, look at the price of oil is so high now because we printed all this money. Now my potential customers are spending so much on gasoline, they don't have anything left over to buy my product. So if business was bad before the inflation, it's even worse. You know, Ron Paul pointed out on the debate that you could still buy a gallon of gasoline for a dime as long as you have a dime that was made before 1965 because it's made of silver. So it's really not that the price of oil is going up. The problem is the value of our money is going down.
Okay, so there's a lot there. I mean, I think that the primary driver in oil prices is probably not what the Federal Reserve is doing, but it's sort of is worldwide demand, right? So,
but isn't that demand coming from all the money that's being printed in order to bid up the price of oil?
Well, I think it's actually coming from expanding industrial production in China and other places. But if you'll, so let's think.
But if the money didn't exist to pay for it, the prices wouldn't be going up. Plus, you know, we're producing a lot more oil now. But if you price oil, you see, if what you're saying is true, you should see oil prices going up in terms of gold, in terms of silver, but they're not. Oil prices are not going up in terms of real money. Prices of oil are only going up in terms of the fiat currencies that central banks are rolling off the printing presses.
Well, I mean, the prices of all extractable resources are going to be sensitive to interest rates. I mean, we can talk about that. But, like, so you could, if interest rates go down, then the price, the sort of opportunity cost of holding oil or gold or any of those other things goes down. And so it makes more sense to hold more of it, even, you know, and that's just an interest rate effect. It doesn't necessarily have to do with the long run price of money. I mean, you can see.
Well, no, I mean, the relationship, historically, you can pretty much see that the price, the barrel of oil versus an ounce of gold is relatively constant over time. Even though there's more demand for oil, the price of oil in terms of gold isn't rising. It's only rising in terms of these fiat currencies. And, of course, if you look at currencies that were not as weak, like the Swiss franc, for example, the oil price in Switzerland wasn't really rising at all. In fact, until the last month when the Swiss decided to cut their own throats, the Swiss were actually experiencing cheaper gasoline because their currency was not being debased.
Right. And Switzerland was also experiencing a negative economic shock because of all that. I mean, we can go through that, but let's
no, it wasn't. They had practically no unemployment. They had a huge trade surplus. The Swiss economy was doing fine.
The trade surplus was starting to go down.
No, it wasn't.
Yeah, this is the entire reason they adopted that policy. But
no, they adopted it for political reasons, not economic reasons.
Well, let's just talk about the price of gold, so we can split these things into their constituent parts. So. Look at the price of gold over time, right? So real gold prices peaked in the 80s and then fell, right? But what happened in the 80s was that the rate of inflation went down and interest rates went down after the 80s, right? But the money supply didn't decrease, right?
That's why gold prices didn't go all the way back down to $35 an ounce where they were when the 70s began. They settled in around $400 or $500. But what happened is when gold got up to $800, gold was factoring in an acceleration in the rate of inflation that was underway. And when we broke the back, even though we didn't contract money supply, we stopped it from spiraling out of control, and we reined in the fear that we would have hyperinflation. So gold got ahead of itself. Gold was anticipating a continuation of Jimmy Carter, and we didn't get that. We got Reagan and Volcker, but we didn't do everything right. But, you know, I want to, leave this discussion a little bit because I know we're running out of time, and I want to talk a little bit more specifically about the president's plan. Do you think the president's job bill will create or destroy jobs?
So on that, I would say it'll probably create jobs. I mean, that would be my estimate.
How is it going to create them?
Okay, so the most straightforward part and the part that I promoted the most was a reduction in payroll taxes, right? So if you reduce payroll taxes, then households will have more money to spend on the things that they want. They'll go out and buy those things. That will create demand for businesses who will then be able to sell their products.
All right, so and it doesn't matter if the things that they're buying are imported and it just runs up the trade deficit because we buy more imported products?
Well, I mean, for American employment, you would prefer that people bought things that were American, but I don't know if it's a good idea to dictate to people whether they can buy.
Well, it pretty much, I mean, if someone takes their payroll tax cut and goes and buys another television set, how does that help the U.S. economy if I bought a television set made in South Korea?
Okay, well, so it's going to help Best Buy, who
but the margin is tiny. I mean, the retail margin at Best Buy on that television set is very small. Meanwhile, where did the money come from? If someone in America went out and bought another television set, where did the money come from to pay for it? After all, the government is not cutting any expenditures someplace else. So how did the government make up the lost revenue from the tax cut?
Well, in the short run, it makes it the lost revenue from the tax cut by printing more money. I mean,
right, so they created inflation, and now they made it more difficult for businesses to expand or grow. They ran up the cost of inputs. Don't you think that might be harming the economy more than just going into debt to buy another television set?
So, but the inflation doesn't just happen by magic, right? So it's not like you just print money and then you just magically get inflation. You print money. Right.
But that is inflation. Printing money is, by definition, inflation. I mean, it doesn't mean that prices go up right away, but it might mean that they don't go down. But I have another question for you.
There's an old definition of inflation like that. But if we want to talk about prices moving, so you print money, prices don't go up right away.
So,
print money, people have more money. They attempt to buy more things. That bids up prices. So
I got another question. Let me stop you. So if you actually think that this tax cut, if the government prints money and gives it to Americans, why doesn't the government just send every American a check for $10,000 and let them buy stuff? I mean, the Fed could print that up. In fact, why not? If printing a little bit of money is going to help, wouldn't printing even more help more? I mean, why not really give Americans some money to spend? Wouldn't there be a boom then?
There probably would be. I mean, I advocated completely suspending the payroll tax cut. I mean, one advantage with
then why not just give everybody a check for $1 million? I mean, if everybody was a millionaire, I mean, wouldn't that end this recession right away? We could all pay off our mortgages, and why don't you just send everybody $1 million?
Okay, so it actually would, but then what you would do is on the other side is that you would create an enormous amount of inflation.
Right? So printing $1 million for everybody would create inflation, but printing $1,000 for everybody does it? I mean, at what magical point?
It creates no. So printing $1 million will create 1,000 times more inflation than printing $1,000, right?
So what you're saying then is
inflation is okay, but 1,000%.
Okay, so what you're saying is inflation is good as long as we just don't get too much of a good thing. So how do you know what's the exact right amount of inflation? That's, it's like, see, I think it's like getting a little bit pregnant. I don't think you can get a little bit pregnant, and I don't think there's, a little bit of inflation is okay. But how do you know? How could you figure out, where does inflation stop being good and start being bad?
Well, I don't know if it's always good, but I mean, but it's a cost that you're willing to bear, right? So I mean, everything. That
Who's willing to bear it? The people that are suffering from it don't want to bear it.
Of course.
Anyway, hey, thanks for coming on. At least it sounds like you got your kid to stop crying, which is good. But I think the whole country is going to be crying if we keep following these Keynesian policies. That is the problem. Anyway, hey, don't go away. We got another half hour coming up. We'll take some calls here on the Peter Schiff Show at schiffradio.com.
The Peter Schiff Show.
It's the last time you're gonna hurt me.
We now return to the Peter Schiff Show.
Call in now, 855-4-SHIFT.
That's 855-472-4433.
The Peter Schiff Show.
This is Peter Schiff here at schiffradio.com. Before my guest came on, it's always interesting to discussing, with the Keynesian because he basically admitted that it would be good if we could just send people more and more money, but at some point the inflation goes from being a bad thing to being a good thing. But how do you pinpoint that number? Because if you say, okay, so if we send everybody a $2,000, that's great, but if we send them $1 million, that's too much. Well, I'd say, what about 500,000? Is that too much, too little? I mean, if they say, well, that's too much, well, 200. I mean, where is it? If they say, well, $10,000 is the right amount. Okay, so what about 10,001? 10,001 is too much, but 10,000 is just perfect. How do you know? See, there's no way. I mean, you can't get a number, because whatever number they say is good, well, I can always add $1 to it, and then they say, well, that's not good. Well, if I can keep it, well, if 10,001 is good, well, isn't 10,002 worse? No, because you can't. So the fact of the matter is, it doesn't matter how much money the government prints and sends out, it won't do any good, because the same reasons that you would use to say $1 million is too much, and you explain why it doesn't work, it applies to 1,000. It doesn't matter how much or how little. Inflation is inflation, and there are negative consequences. There are winners and losers. It is a net transfer. The government does not help the economy grow by growing the supply of money. If you could do that, then everybody would do it and it would work. It doesn't work. What works is sound money. What really increases an economy is production. It's more goods and services being produced, and that's how you grow an economy. Just changing the amount of money, all that does is changes the price of what's been produced, and in many cases it inhibits production. Like I talked before the break about the one of many rules in the brokerage industry that is impacting me, on interstate commerce. I gave that one example, but there are many. There are many ways that the government regulations hurt the brokerage industry. There are all sorts of. That was just one example of how to drive up the cost. And if some individual wanted to be a broker on their own, just the cost of licensing up in all the states is very prohibited. But that's just one of many costs that the government has layered on. I just got an email from my brother, and this is regarding lawsuits that are being filed by companies down in Louisiana. Apparently, there's companies use a lot of guest workers legally that come into the country, and they skin alligators or crawfish or shrimp, and they're paid in a way where the more fish they skin, the more they make, and however the compensation works, it's agreeable to both parties. Obviously, Mexicans wouldn't be crossing the border to collect a paycheck if it wasn't in their best interest, and apparently there are other American jobs that are being created because of the guest worker program. But apparently some new regulations that the government wants to enact would basically force these companies to almost double the wages that they're paying these guest workers. And basically what the companies are saying is this would put them out of business, because it would now increase the cost so much that we would not be able to do this business domestically. We would then have to import these products from abroad, thus thereby running up our trade deficit and destroying more American jobs. Not only the jobs of the guest workers who are coming over the border, but the workers of other people who are benefiting from the fact that these guest workers are coming in. And again, here you have, just like in the case of Gibson Guitars, you have the Obama administration figuring out ways to destroy viable American jobs that already exist. And just because they want to come up with a bill and put some label on it and call it the Jobs Act doesn't mean it's going to create jobs any more than the Patriot Act is patriotic. It doesn't matter what the bill says. I always say if we only had truth in labeling laws that the Congress writes, if it only applied to legislation as well as the private sector, and then they would have to label the bill what it is, right? The Job Destroying Act, the Deficit Growing Act. See, nobody would vote for it then if they actually said what it was. See, they want to give it this, if they want to pass a law, let's say they want to pass a law, the safe, the Safety for Children Act. So if anyone is opposed to it, whoa, you're not in favor of safety for our kids? What matters is, what does the bill say? What if the bill actually endangers our kids? It doesn't matter if we call it the Safe Child Act, if it puts our children in danger. And just because they take a job-destroying bill and they say Job Creation Act, It doesn't mean that I'm opposed to jobs because I oppose this act. I understand what the act is actually doing. I'm not just trying to produce a soundbite. And if the Obama administration really cared about jobs, they would stop destroying the jobs that we have, and then, while pretending that they want to create more. Anyway, let me go to the phones. I got one person, Joe in New Jersey, who's been on hold for about an hour. Joe, thanks for your patience, and welcome to the show.
Yeah, thanks for taking my call, Peter. Okay, I have a question, two questions. One is that about the oil price that you mentioned, which will increase in the close futures. I'd like to, I was thinking about, could there be a chance that Obama may, use the oil price to do something for his campaign, maybe, to drop the oil price, so to say that, the price of the oil is decreasing, so I'm doing the good job.
Yeah, well, I don't know. The only thing that they could do is to dump more oil out of the strategic reserves, but that's not going to have that long-lasting effect. I think more likely than not, the president will try to use the higher price of oil as an excuse. See, he might try to say, well, it's not my fault because oil prices went up, and that's beyond my control. It's because of OPEC, and so he might try to use an excuse as to why, if I can't, the economy is weak, but it's not because of me. Look what happened to oil prices, and he also might use it as an excuse to go after the oil companies themselves, to turn the public's anger about higher oil prices into anger at the oil companies, right? In order to diffuse or misdirect their anger from the Federal Reserve, where it should be, and for Congress for running up these deficits that the Fed has monetized, if they can point the public's anger at the more obvious target to most people, which are the oil companies that they think are gouging them, then maybe the president will use that anger, hatred for the oil companies to his political advantage, running against the oil companies, maybe imposing some kind of punitive tax to get even, with the oil companies. That's the only way I think it comes into play.
Okay. Now, my second question is that is about the gold price and also the gold stocks in the 2008 or 2007. I also agree with you that saying the gold is the safe haven, but I don't understand the concept why during the late 2007 and the 2008 everything fell down, like the gold price, the gold stock, the Dow, anything and everything.
And what happened? And still, gold went down less than other assets. So if you look at the price of stocks measured in terms of gold, stock prices still fell in terms of gold. But yes, gold prices went down in terms of dollars and in terms of some other currencies. Not all currencies. The gold price actually went up in terms of some currencies, but it went down in terms of the dollar. And I think the reason that happened was that people for a brief period of time didn't know what was going to happen. They knew that it was possible that the government could have done the right thing and allowed the deflation. They could have allowed the banks to fail. They could have not stimulated. They could have not bailed out. And that might have been bearish for gold and bullish for dollars, because it would have meant a huge reduction in the supply of money, and it would have been, a real deflationary correction. And I think people were bracing for that. People now know that that's not happening, that the central banks have shown that they will refuse to allow any market-based solutions that would increase the purchasing power of money and allow asset prices to deflate. So people now know that there's going to be endless printing. Rather than default, rather than people losing money, the government is going to have money lose value instead. And so that is why I think gold is now rising as opposed to falling, because that reality is now clearer to more and more people. Back in 2008, it wasn't clear. A lot of people didn't understand that this was going to happen. They know it now. And, of course, anybody who sold gold in 2008 down at 700 or 800 obviously regrets it, and they don't want to make the same mistake twice, given that now it's, around 1900.
Okay, I see what you mean. Okay, thank you very much, Peter. Thanks.
Thank you for calling. Also on the line now, Mike from Brooklyn, New York. Mike, you're on.
Hey, Peter, I was going to ask you about silver mining stocks. Instead, how did you go about getting invited to speak in front of Congress?
I don't know. The congressman just contacted me by email, the committee, and said, would you like to speak? And I said, certainly. I mean, I would welcome any opportunity to help educate our elected officials, it'd be great. And, of course, I'm going to give them economic advice that is exactly contrary to how I'm investing my own money. You see, if Congress actually does what I'm going to suggest, that's going to be good for the American economy, but negative for gold. It's counter to my own interest as an investor, but it is in my interest as an American. I want the government to get it right. I'm not investing the way I am because I'm un-American. I'm investing the way I am because I understand reality. I'd rather be betting on America than against it. But the problem is Congress has made, betting against America, kind of like a sure thing. Although, nothing's a sure thing when it comes to the security regulators. But I want to change the odds. I want there to actually be a chance that we could succeed. I don't want it to be a foregone conclusion that we're going to fail. But I know if we continue to pursue the policies we're pursuing now, we will fail. I know that we can't put out a fire with gasoline. That's no matter how much gasoline we put on the fire, it ain't going out. I'm trying to convince these guys to stop pouring gas on the fire and maybe try water. Maybe try smothering it with something. I mean, I've got solutions that'll work. So, anyway, hey, thanks for calling and thanks for your patience. Stick around. We got one final segment coming up here on the Peter Schiff Show on SchiffRadio.com.
The Peter Schiff Show.
To President Obama, Secretary Geithner, Madam Pelosi, and all of the socialist econ professors across America.
We're sorry. Peter Schiff is back on the air.
And this is Peter Schiff here at SchiffRadio.com. I want to take a little break and play a couple of sound clips that I've got here. First of two is this is Bill Maher, who was on the Jay Leno show on the 9th. And here he is, trying to explain the Republicans, and again, bringing up the issue of race to try to explain why the Republicans are opposed to the Obama plan. Here, cut number one.
He's got to understand about the Republicans. It's not the entree they don't like. They don't like the waiter. What he has to understand, if I could give him one bit of advice, it would be stop trying to make everyone like you. You could give all the money to the rich. Yeah. They will still call you a socialist. They are never going to like him. He could personally save them from drowning. They would still not like him. He is the wrong age, the wrong party, the wrong color. He will never pry their irrational fears from their cold, dead minds, and he should just stop that tactic.
So, in other words, Bill Maher is convinced that if a Republican were to serve up the same dish as Obama, or maybe even a white man, right, if it was a Democrat, but if he were white maybe, that the Republicans would accept it, that they just don't like it because they don't like the color of Obama's skin. All the racism is on the liberal side. It doesn't have anything to do with the color of his skin. If a black man were to bring up the correct policies, then maybe the same Republicans would applaud it. It's not the color of his skin. It's the content of his character. It's the content of these policies. It's what he wants to do. Now, I do agree that there is a lot of hypocrisy in that when President Bush proposed stimulus along the same line of government spending, a lot of Republicans supported the stimulus under Bush and now oppose the same concept under Obama. Now, some of that maybe is legitimate people learning from their mistakes, but a lot of it is partisan. But I know one thing's for sure, it's got nothing to do with color. If George Bush were black, it would have been the same. Nobody is making these decisions based on the color of Obama's skin. Yet guys like Bill Maher keep want to harp on that same thing. Anyway, look, here's a little bit more from Bill Maher. Cut number 2.
I don't understand his theory of constantly going half in on their crappy ideas.
Yeah.
You know, when you're having a budget negotiation, of course they're going to threaten the poor, the elderly, children, the planet, because that's who they are.
Yes, that's who the Republicans are. They don't like the elderly. They hate the children. They want to destroy the planet. See, again, this is how the left reacts when the right objects to what they want to do. You see, because, again, a liberal is all emotion. When Bill Maher thinks, he doesn't use his mind. He uses his emotions. And when somebody is opposed to what they do, it must be because they're a bad person. The reality is people who oppose the liberal agenda do so for the same reasons that Bill Maher supports it. Only they understand how it works. They understand that all these well-meaning laws will backfire and hurt the poor, hurt the elderly, hurt the children. It's because the conservatives or the libertarians, because they care about children, that's why they want to stop Obama, because he's destroying their future. He's destroying their present with his policies. Anyway, moving from Bill Maher, listen to Chris Matthews talking about FDR and Social Security. Here's first cut, number 3.
The genius of Franklin Roosevelt, who was a great president, maybe one of the greatest 2 or 3, I think, was that he figured out that Social Security had to be for everybody, no means test, you paid for it while you worked. When you retired and had no other form of income, this would help you out.
Yeah, now, if FDR was a genius, it was only a political genius. The reason that FDR wanted Social Security to be for everybody was to create a constituency, a large vested interest of people who would constantly vote for politicians promising them benefits. And Roosevelt said that. He said nobody will dare take this away because they're going to be voted out of office. This was a plan to generate votes. It was to create a captive audience of dependent voters, dependent on a government benefit that no one would dare take away. If you want to say it was genius politics, hey, maybe. But genius economics, the exact antithesis of that. It's one of the worst things we've done here. But I'm going to play the next cut, which is pretty interesting, for the same from Chris Matthews. Cut number 4.
In those days, if you made the 65, you were lucky. You got a few bucks on a Social Security. Today, lots of people, fortunately, make it past 65. They live into their 80s and 90s. They're still getting those checks. The system doesn't work that way anymore. It's not as healthy as it once was. So how does a Republican deal with the fact it is a Ponzi scheme in the sense that the money that's paid out every day is coming from people who paid in that day?
Well, there you have. At least Chris Matthews is admitting that Social Security is a Ponzi scheme and that Rick Perry has it right. Now, of course, he's upset that people aren't dying sooner. You know, unfortunately, people are living too long, so it's screwing up the Ponzi scheme. Yeah, it's screwing it up because they're hanging around longer, collecting the money. There's more chain in the chain letter. It's a bigger pyramid. But he's admitting, he's saying it's only a Ponzi scheme in the sense that the money is coming in the money is going out based on the money that's coming in. Well, that's the only sense. That's what makes a Ponzi scheme a Ponzi scheme. Bernie Madoff could have said the same thing. Well, it's only a Ponzi scheme in the sense that I'm paying off the current investors with new investors. That is the very heart of what makes a Ponzi scheme, right? So you can't say it's only in that way that it's a Ponzi scheme, because once it's funded that way, it is a Ponzi scheme. But to answer Bill Maher's question, how do Republicans deal with it? They acknowledge it. They acknowledge the truth of the matter and then try to deal with the problem instead of pretending it's not a problem. If you pretend that Social Security is not a Ponzi scheme, then you can't deal with the issue. The only way to deal with the issue is to acknowledge what it is, because you can't cure a problem that you don't understand. And maybe Matthews at least seems to understand it, but he just doesn't want to deal with it. I guess that's the difference. Anyway, let me try to take one more call. Barry calling from Champaign, Illinois. You're on.
Thank you, Peter. I appreciate that. The problem of hiding reality. Obama is defunding Social Security in order to effectively reduce the minimum wage, in your terminology there. Defunding Social Security creates a crisis of moving up the 2037 date when Social Security goes officially insolvent, and surprise, surprise, being hidden from the American people.
Yeah, well, he's defunding it in two ways. One, by cutting the payroll tax, but also by creating inflation that is not incorporated into the COLAs. Social Security benefits are being reduced every year. The government just doesn't acknowledge it because the reduction is taking place in secret through the inflation that the Federal Reserve is creating. But your point is right about the spending cuts. Anyway, we're out of time for today's show. Tomorrow it's Tom Woods. I'm going to be educating or attempting to educate our congressman. I'll be back again on Wednesday for a full 2 hours of the Peter Schiff Show on SchiffRadio.com, the gold standard in talk radio. Bye for now.
Light up my life.
The Peter Schiff Show.